Good morning, good afternoon, and good evening, everyone. My name is Andrew Apampa. I'm an Associate Director on the content team here at Convergence Blended Finance, and we're very happy to welcome you all today to the launch of the Spring Edition 2025 of our State of Blended Finance report. Next slide, please. A few housekeeping issues. First of all, this event is being recorded, and we'll share that recording with everyone. We'll have two Q&A sessions during this webinar, so please do use the Q&A function to ask questions during those sessions. And finally, please do download and read the report at www.convergence.finance/resource. Next slide, please. Turning now to the agenda for today's 90-minute webinar, I'll start us off with some opening remarks about this year's report, and then I'll hand it over to my colleagues on the content team to present key findings. Following that presentation, you'll have a chance to ask questions to the team in a Q&A session, and we'll then move on to a panel discussion, including 4 expert voices from the blended finance industry, moderated by Convergence's CEO, Joan Larrea. There'll be a final panelist Q&A session before Joan will close out today's webinar with some final remarks. Next slide, please. The Spring 2025 edition of the State of Blended Finance comes at a critical moment for the industry. Unprecedented cuts to ODA across the board and the dismantling of USAID pose major questions to the future vitality of the blended finance market. As usual, in this year's report, we present an overview of the overall blended finance market as it stands today. However, the Spring 2025 report also considers data from 2024 and doesn't reflect the impact of this new ODA environment, which will start to feed through into our data over the coming year. Instead, this report offers an indication of the period before and will provide a helpful benchmark for the future. To mark Convergence's 10-year anniversary, and with us halfway through the decade of action, this year's report assesses the progress that we've made in addressing the key challenges to scale that Convergence identified at the opening of the decade. We also present a forward-looking agenda that can direct action in the years to come. Finally, this year's report is presented in a new slide deck format to package the same quality and depth of analysis in a more easily digested and succinct format. With that, I'll hand over to my colleagues on the content team to take us forward in today's presentation.
Thanks, Andrew. I'm Ishwari Savant, and I'm a senior associate on the content team. I'll be sharing the insights on the deal activity we've seen in the past year. We can move on to the next slide, please. Thank you. So following record high volumes in 2023, the blended finance market demonstrated resilience in 2024, despite ongoing macroeconomic uncertainty. The deal flow reached $18.3 billion last year, surpassing the market average for the previous 4 years. And this reflects the growing ambition and scale that we want to see in the blended finance market. In fact, the median deal size rose significantly, from $38 million for 2020 to 2023 to $65 million last year. Now, while the upward trend is encouraging, blended finance is still not being deployed at the scale required to close the SDG financing gap. Scaled blended solutions are therefore becoming increasingly crucial, especially through what we refer to as whale deals. Although these billion-dollar-plus deals accounted for only 2.5% of the transactions over the past 3 years, they have mobilized approximately 27% of the total capital. In fact, the drop in overall volume in the past year is largely due to a lower number of these transactions. In 2023 alone, whale deals represented around 45% of total blended finance volume. That said, these deals have not disappeared. Last year, the market still saw 3 whale deals. This included Brookfield's Catalytic Transition Fund and TPG's Global South Initiative. I just want to note that we do often see reporting lags in the market, and this does impact our data coverage as well. We do expect the 2024 figures to rise in the upcoming State of Blended Finance Climate Report that we publish in the fall. Moving on to the next slide, I'll highlight the shifts we've observed in the sources of capital flowing into blended finance. Public and private sector contributions have been nearly equal for the past 2 years. However, the private sector has emerged as a leading provider of commercial capital, surpassing DFIs and MDBs. In 2024, private investors contributed $1.8 billion more than DFIs and MDBs combined. We've also observed a strong rebound in ODA allocated to blended finance, with an 80% increase compared to 2023. This resurgence was primarily driven by a few key actors, though, most notably UAE's Altera Fund and Japan's development agency, JICA. A portion of this increase in ODA can also be attributed to the growing use of blended finance to support economic recovery and reconstruction. Last year, deals in Ukraine represented 3.5% of total ODA to blended finance, up from just 1% in 2023. Finally, consistent with the trends observed in 2023, Convergence recorded $1 billion in concessional guarantees last year, which is a 42% increase year over year. This growth is closely tied to the changes in the vehicle landscape, which we'll explore further now. Next slide, please. The increase in guarantees in 2024 can be largely attributed to the rise of risk-sharing agreements between DFIs, MDBs, and financial institutions. These types of transactions made up 33% of all the deals last year, which surpassed projects and companies that had been the preferred vehicles in the previous years. Convergence has historically emphasized aggregated vehicles like funds and bonds as effective tools to reach a broad range of stakeholders, including SMEs and smallholder farmers. The rise of risk-sharing agreements aligns with this approach. In the blended finance market, DFIs and MDBs are increasingly partnering with commercial banks to support their lending portfolios, enabling these banks to then expand credit in local currency to underserved sectors while diversifying their balance sheets. Turning to funds now on the next slide, this vehicle mobilized more capital than any other in 2024, totaling $5.1 billion, despite accounting for just 9% of all deals. This shift highlights that funds are emerging as the most scalable and replicable blended finance structure, drawing increasing interest from private sector actors, especially institutional investors. We're also seeing a greater concentration of experienced fund managers in the blended finance market. Many are impact-first asset managers with a strong track record, having launched and managed multiple blended funds in recent years. While traditional fund managers are less represented in the blended finance market, their presence signals a promising opportunity for greater mainstream participation. In fact, the median fund size managed by established asset managers in the past 6 years was $612 million, which is substantially larger than the typical blended fund size. Moving on to projects on the next slide, while they are no longer the dominant vehicle, projects are growing both in size and strategic importance. The median deal size rose from $70 million in 2023 to $100 million last year. They also mobilized $4.6 billion of total financing. Notably, 6 of the whale deals in the past 3 years have been large-scale projects, which has outpaced funds and companies. I'll now hand it over to Alyssa to discuss the investor trends.
Thank you, Ishri. My name is Alyssa Palala, and I'm an associate on the content team. Now, next slide, please. We can turn to commercial investor activity in the blended finance market and how financing volumes have shifted over recent years, specifically the rise of financial institutions' participation. In 2024, the most active commercial investors are financial institutions, accounting for 55% of commitments and leading in financing volumes at $3.4 billion. Just over half of these commitments were supported by DFIs and MDBs to support on-lending activities, while 15% and 14% respectively were direct investments into projects and companies. It's important to note that while financial institutions are the top lenders, these are not to be confused with financial institutions as recipients of risk-sharing facilities from DFIs and MDBs, but rather multinational banks that invested in projects and have supported domestic financial institutions in emerging markets through on-lending activities. We have also seen an increase in institutional investors' participation, reaching 16% of commercial commitments in 2024, with the financing volume rising to $1.7 billion. This investor class tends to favor blended funds, a trend supported by the increasing fund size in recent years, which has helped attract large institutional investors. As of 2024, institutional investors accounted for 50% of private sector commitments to funds. Notably, two whale funds, as Ishwari previously mentioned, Brookfield's Catalytic Transition Fund and TPG's Global South Initiative, represent a significant portion of institutional participation in 2024. Moving to the next slide, here we focus on the need for foundations to play more of a catalytic role and the different ways development agencies participate in blended finance as concessional actors. Development agencies and multi-donor pools continue to be the largest provider of capital, accounting for 65% of total commitments over the past 3 years. While development agencies have traditionally allocated funding through investment stage grants, there's been a notable shift towards risk-sharing instruments. In 2024, they most frequently deployed guarantees and senior concessional debt that is typically administered by DFIs and MDBs. This shift reflects a broader effort by development agencies to stretch scarce concessional resources by leveraging instruments that can return capital where possible, while reserving full concessionality for transactions that truly require it. This year, we have classified development agencies, such as JICA, and donor-funded concessional pools, such as LEAP, administered by the Asian Development Bank, as direct contributions, and multi-donor funds, such as the Green Climate Fund, as indirect contributions. We found that direct contributions have surpassed indirect investments in the past 3 years. USAID tops direct contributions by donor agencies and bilateral concessional pools, with most of these commitments directed towards the agriculture and financial services sector, and JICA leading in financing volumes, contributing $1.8 billion over the past 3 years. With ODA levels projected to decline in the coming year and the suspension of USAID operations, it can be expected to see these impacts on the blended finance market and availability of concessional capital moving forward. Next slide, please. However, this shifting landscape can result in a larger role to be played by philanthropic investors. While foundations have typically represented a smaller share of catalytic capital to date, reflecting only 3% of commitments in 2024, their unique investor profile, characterized by higher risk tolerance, longer investment horizons, and fewer asset class constraints, position them well to step in. Foundations can also partner with public sector actors to increase the pool of catalytic capital. For example, the European Investment Bank and the Bill and Melinda Gates Foundation partnered to launch the Accelerating Human Development Guarantee Facility for health infrastructure. I'll now pass it over to Robin to discuss the thematic portion of the report.
Thank you very much, Alyssa and Ishwari, for walking us through the data trends from the report. I'm Robin Ivory, a manager on the content team, and over the next 5 minutes or so, I'll be looking backwards a bit to understand how the blended finance market has evolved in the past 5 years, and also where there are opportunities for it to continue to improve. In the 2021 State of Blended Finance report, Convergence identified 4 key challenges to achieving scale in the blended finance market. First, there was a lack of collaborative private sector mobilization strategy and action plan between catalytic capital providers. Second, local investment in blended finance was underrepresented. Third, there was a lack of data transparency within the blended finance market. And lastly, the ecosystem for blended finance was underdeveloped, especially regarding the lack of financial intermediation. This year's report provides an update on these challenges, highlighting where improvements have been made to address them, and providing calls to action to the blended finance market overall. We've also discussed the potential impacts of changes to ODA funding within each of these themes. I'll briefly be discussing 2 of the challenges, namely that local investment was underrepresented and that there was a lack of data transparency in the market. Moving on to the next slide, regarding local investment in 2021, Convergence found that many local actors were largely missing from the blended finance market. While blended finance has a goal of mobilizing large amounts of capital, and this of course depends on global investment, incorporating local investors is important to fulfilling its longer-term objectives. In the long term, local investors have a few additional benefits. For one, They have a better understanding of local investment landscapes, so they require a lower risk premium compared to their global peers. They can also invest in local currency, so there's less need for hedging costs. And finally, they can build momentum for further participation from local actors in SDG-aligned sectors. So what's the story in 2025? We note that local investment in blended finance continues to be underrepresented, accounting for under 20% of all blended finance investments across all regions by investment count. We also found that many of the barriers noted earlier continue to persist. One of these challenges is that local banks rely on short-term deposits, so they can't provide the longer tenured loans needed for things like infrastructure projects. There are also stringent counterparty limits that restrict local banks from Given the current situation, with traditional sources of global blended finance flows being reduced, we'd note that local capital mobilization will become ever more critical. And since there's still progress to be made in increasing participation from local investors, Convergence suggests a few calls to action. Our overarching call to action is to create an enabling environment for blended finance through local blended finance initiatives and global South-South collaboration. We've seen some successful examples of this to date, like the country-level concessional finance platforms, such as the government-administrated blended finance programs as led by the Development Bank of Rwanda. And we'll be hearing more about Rwanda's efforts from the Ministry of Finance in the panel discussion. The second challenge, moving on, I'll be briefly speaking to is a lack of data transparency in the blended finance market. In the 2021 report, we noted that concessional capital providers rarely share financial terms or post-investment outcomes with the public, and this limits the evidence base for supporting blended finance overall. Notably, these investors also don't seem to actively encourage or require private investors to share financial data in a transparent manner. Ensuring data transparency can be especially important regarding data on the amount of concessionality within a blended transaction. Providing this information means other investors can be more effective and responsible in using limited catalytic resources. So again, where are we in 2025? While data transparency has seen some notable improvements, there are still significant challenges with disclosure from ODA providers, DFIs and MDBs, private investors, and other funding sources such as foundations. There are some initiatives that are attempting to address these challenges. So, for example, the Global Emerging Markets Report has included for the first time this past year statistics on recovery rates for default events. Including these statistics is important because it helps investors assess expected loss in the event of a default, providing a clearer picture on the financial risks involved. There have also been other ad hoc attempts since 2021 to bring awareness to the need for data transparency. Cuts to ODA, however, have slowed progress in some areas, most notably due to funding cuts. Publish What You Fund will not be developing the 2026 version of the Aid Transparency Index. To address this challenge moving forward, we again provided a few calls to action. One being for concessional catalytic capital providers to require data transparency from private sector investors. These investors often set the terms of engagement and are uniquely positioned to mandate public disclosure of key deal information. To see further analysis on the challenges facing blended finance, please refer to the full report. But for now, I'll stop here and we'll move on to the Q&A portion of today's event. Thank you.
Thank you very much, Robin. And thank you to the team for that interesting presentation. So I'll be facilitating the Q&A this morning. So once again, as a reminder, please do share any questions that you have on the Q&A channel, and we'll do our best to address them. So first, maybe a question that will be top of mind for many people on this call. The global reduction to ODA was mentioned a couple of times during the presentation. Can you elaborate on what this actually means for the blended finance market and the availability of concessional capital? So maybe, Robin, you can take this one.
Great. Thank you so much, Andrew. And yes, we have seen a reduction in ODA, which will, of course, have implications moving forward from the blended finance market. One thing that we can say is that we've seen the blended finance market grow significantly in recent years. But obviously, with the strain of the drop in ODA and the overall weak investor appetite for developing countries in general, we do anticipate a drop in transaction volume. We especially expect to see kind of more streamlining in the field. So where deals that require maybe longer term and ongoing ODA, or those that are supporting pilot transactions, those might decrease in favor of things like prioritizing near bankable deals. Aid may also become more conditional upon the donor country's own benefit. And over time, we may see the outcomes of this in the form of things like more frequent blended transactions that support the ODA's country's own investors to enter new markets, or that provide access to strategic resources. But with these challenges, we also think that blended finance is poised to become more strategic and efficient. And this actually might be the push that we need for blended finance to scale, especially through standardization. And I'll just give a quick plug here as well for a new initiative that Convergence has just launched. And this is called the Scale Private Investment Mobilization Project. This project is to help standardize and scale up effective and proven investment models. And we've identified 12 replicable models, and those are now available on our website. So I encourage everyone to check those out. So hopefully that answers your question.
Yeah, thanks very much, Robin. So continuing in that vein of, some of the things that we heard within this morning's presentation, we highlighted, or it was highlighted in the presentation this morning, the significance of billion-dollar whale deals in the blended finance market. And this is something that we've also written about a lot in prior years. So I wondered if the team can unpack why these deals matter so much, and whether the drop in transactions in 2024 is a cause for concern. Was 2023 simply an outlier, or are we seeing a broader shift? So maybe Ishri, you can take this one.
Perfect. Thanks, Andrew. So I just want to start off by emphasizing that we're not measuring the impact of these transactions solely by their size. Every deal that we capture is aligned with at least one sustainable development goal, and they all have, impact outcomes that they're measuring. That said, though, the large deals do stand out for their strong signal that they send to the market. They demonstrate continued mainstreaming of blended finance and real progress in scaling as well. I think these transactions are also more uniquely positioned to attract institutional investors. And that's something that we've mentioned in our presentation as well, that we've seen more institutional investor participation in these whale deals. And this is important for closing the SDG financing gap. I think importantly, most of these whale deals also target climate adaptation, mitigation, or a combination of the two, which is also very significant. And while the 2023 numbers were, quite large, and we saw quite a few of these transactions in 2023, we don't believe that it was an outlier. We are tracking several blended finance funds that were launched at least either in the end of 2020 or in 2024 as well, many of which just haven't reached first close yet. So even the two whale funds that we've mentioned in our presentation have only reached 50% of their target. So that, of course, also impacts the total volume that we've captured. And I think just one thing I want to add as well is that we have seen also more $250 million plus deals, $500 million plus deals. So in the last year, and this is definitely a sign of scale that we've been advocating for in the blended finance market. I'll pass it back to you.
Thanks very much, Ishri. And actually, I think it would be interesting to delve into another data point that I saw highlighted in the presentation this morning. So the increase in the number of lending arrangements with financial institutions last year was highlighted in this morning's presentation. I wondered if you could share any more detail on which types of beneficiaries or regions are being prioritized through these structures and why.
Yeah, definitely. So as I mentioned in the presentation, these blending arrangements do represent an effective way and an aggregated approach to reach a number of beneficiaries. And I think what really stands out in these deals is just the impact objective. So what we've seen is that around 80% of these deals supported small businesses, and around 35 to 40% specifically targeted agriculture finance. I think what's even more notable is that these about 50% or more of these transactions were gender responsive based on our methodology. So we've seen the strong focus on women-led businesses and entrepreneurs, which is quite significant as well. I think regionally, we've seen a strong concentration of support for commercial banks in sub-Saharan Africa. But what's more notable is this surge in activity in Ukraine over the past year. So we've seen more blending arrangements with commercial banks in the country. And this was actually the most common financing structure that we saw for Ukraine, which surpassed facilities and project-based deals that we had seen previously. And that actually resulted in Ukraine being the top recipient country last year. So that was quite significant as well. I'll pass it back to you.
Thanks very much, Ishri. So I've seen another question come in the chat relating to concessional capital, and why would concessional capital providers not disclose their financial terms and post investment outcomes publicly? So maybe Robin, you can take this one.
Great, thank you, Andrew. I think there's kind of a long and short answer to this, but I think the short answer is generally that data is seen as proprietary, and there's issues around confidentiality and competitiveness. So there's an interest in keeping some data proprietary due to concerns around competitive advantage within the concessional capital donor community. And likewise, we've heard that from private investors as well. However, catalytic capital providers do have the opportunity within early negotiations of transactions and as influential donors and capital providers to encourage private investors to release more of their data, and also to lead the way and make changes to their own data transparency policies by making those more publicly available. And I would also like to address, there was a question about requiring what's required for an enabling environment to allow for local blended finance initiatives. I think what we've seen is there's a lot of concerns around risk return appetite, and that's the primary area that blended finance deals with. So when we're looking at what is required for blended finance, and for private investors, and especially local private investors to participate, there's a lot of concerns around ensuring that the risk and return ratios align with their expectations. That's where concessional capital can come in to help. But there's also other regulatory and policy environmental changes that governments can get involved in to create a more enabling environment and reduce the risk. And there's also additional things that donors can do. So they can do things like provide design stage grants and technical assistance to allow for a feasible pipeline of bankable projects to exist within certain geographies. So I will say one thing again, as a plug for something we're working on now. Convergence is currently working with UNDP to put together a policy framework for creating an enabling environment for exactly this, the local and international private investor participation in blended finance. And that is focused in Asia and Southeast Asia. So stay tuned for more work on that front. But for now, I'll pass it back to Andrew.
Thanks very much, Robin. I've seen another question come in the chat relating to what we were mentioning before about whale deals and how they are likely to be impacted by cuts in ODA. So I'll hand it back to the team maybe to try and address that question.
I could take that question. So we don't expect the ODA cuts to impact the way what we've seen is that when we calculated the leverage and the mobilization ratios as well, these whale deals have shown that they require less concessional capital to mobilize more private capital. So, that's something that it just shows that there's the concessional capital is being used more efficiently in these transactions. And I think what's also significant is that we've seen them attract more institutional capital and private capital in general through these deals. So we don't really expect the whale deals to be impacted as much by the ODA cuts.
Thanks very much for that answer, Ishri. Another question that we've seen relates back to commercial banks and other financial institutions, which were identified in the presentation as the most active commercial investor. So I wondered what factors are driving this increased participation from commercial banks? And maybe we can hand back to the team to try and address that.
Take that question. Thank you, Andrew. So we've always seen commercial banks participate as commercial investors. Historically, we've seen them as multinational banks, so MUFG or SMBC. However, now we are capturing more domestic banks in our data, so that can actually be attributed to different blending arrangements with DFIs and MDBs, and that has also resulted in a rise in local currency financing for many of our transactions.
Great, thank you, Alyssa. We've seen another question come in relating to the role of philanthropy in blended finance approaches. Do we have any insights about the specific catalytic role that philanthropy can play to unlock private investment? So yeah, over to the team.
Great, thanks, Andrew. I will take that. This is an excellent question because we at Convergence are really calling on philanthropic community and foundations to step in and help fill some of that gap that's going to be left from reduced ODA funding. So foundations and philanthropic organizations are generally really uniquely placed to play a catalytic role in blended finance transactions. And that's because they have very flexible and mission-driven financial goals. So we've seen foundations participate across the breadth and depth of blended finance transactions, everything from providing design stage grants to acting as senior equity investors within a capital stack of a fund. So what's important is that there are certain regulations with foundations that allow them to participate in specific ways, especially in the US. So of course they have things like PRIs, MRIs, mission-related investments. There is to understand how those can be used to act more catalytically. So in particular, their endowments can be used to invest in more mission-related investments. So not just take a concessional role, but actually act as commercial investors in very risky sectors or sectors that have high impact. We can also see them take concessional positions within the capital stack using the parts of their endowment that they're able to do so with. And then, of course, like I said before, they can do things like provide grants really early stage in very nascent markets and act as a signal to the rest of the market that this is a solid investment. And one final way I'll just quickly mention is foundations are really at a good point to be able to partner with DFIs in particular. We've seen a number of initiatives that have come through where foundations and DFIs are partnering to act as very catalytic sources of financing within the blended finance market. So overall, foundations and philanthropic organizations can really play a critical role, and we'll see that happen more and more with the current environment.
Thank you very much, Robin. Super interesting answer. So we've seen another question come in asking us whether we have ways to measure the efficiency of the growing grantees to mobilize additional private funding. So are guarantee funds too generous and not fully utilized, or not enough? So yeah, a question on how we're measuring the efficiency of guarantees to mobilize private funding. So I'll throw that back to the team and see if anybody would like to answer.
I could take that question. Thanks, Andrew. So we have seen that guarantees are quite efficient in mobilizing private capital, I think mainly because they are often unfunded and no capital is also disbursed unless the guarantee is called. What we've also observed is that the guarantees historically have a higher leverage ratio, which means that every dollar of concessional capital leads to more commercial capital from either DFIs, MDBs, and all the private sector as well. We've also found that, what we've observed is that guarantees need to be structured more to deliver these investment grade assets that key investor groups require to even think about participating in emerging markets. So that's essentially, I think, why we're seeing this increasing use of guarantees as well in the market.
Thank you so much for that answer, Ishri, and thank you to the team for participating in this Q&A. I think that we can maybe end this section of today's presentation here, and maybe I'll hand over to Joan, who will be facilitating a panel discussion next. So over to you, Joan.
Thank you very much, and good morning and good evening to everybody listening. Thank you for being with us. I am delighted to introduce a panel today, and I would ask our panelists to come on camera, and I will introduce in just a moment, but let me just set the scene. as you've just heard from my colleagues, the 2024 scene, it was a difficult year, but that year does not yet reflect the current reality of a sharp drop in official development aid, or ODA. And most ODA goes elsewhere, such as into humanitarian work. Only a couple percentage points of ODA goes to blended finance, yet it's the primary source of concessional money into blended finance. We don't yet know how the drop in ODA writ large is going to play out in the blended finance field, but let's assume a downside scenario. And so with that in mind, I would like to bring out some views from the vantage point of respectively a development finance institution, a philanthropy, an international institutional investor, and a national government on first what leadership they can demonstrate in this situation, and also what they need from others. So if I have our panelists on camera, great. Our panelists today include Sarah Marchand, who's the Director of Capital Solutions at British International Investment, which is the British Bilateral Development Bank. Iftin Fattah, who is a Senior Program Officer of Development Policy and Finance at Gates Foundation, which is a big actor in our space. Marie Ami-Bouri, Head of Impact-Based Finance at Societe Generale. And finally, Nick Durant, who is a Special Advisor for the Ministry of Finance of Rwanda. So in no particular order, I'm just going to launch into the questions. And Sarah, I'm going to start with you at BII. So with the need to stretch scarce concessional resources more apparent than ever, how is BII planning to use that limited resource to be most additional? And if we step out even more broadly, can I just ask you what role development finance institutions should be playing to support blended finance in this scarce ODA environment?
Thanks, Joan, and thanks for having me to participate in this session. It's a true honour and interesting and, I suppose, exciting to be discussing the state of blended finance at this kind of quite unusual, unprecedented moment in the history of international development with what's happened earlier this year. My role at BII is in a team called Capital Solutions, and we spend our time focusing really, Joan, on exactly the question you've just asked me, which is how can we make the most of the catalytic capital that we have access to from, and ours all comes from our shareholder, FCDO. And as you say, that question of how can we use it and how can we deploy it most effectively is more important than ever at a time where that kind of capital is becoming more scarce. Well, we, like many others, are signed up to the DFI and MDB private sector blended finance principles. And I won't talk through all of those, but I think there are three kind of aspects that flow from that are really kind of front of mind for us whenever we're deploying blended finance and catalytic capital. And the first question, frankly, impact, right? That's the first question we ask ourselves. What is the impact of the particular transaction that we're looking at, and what role can catalytic capital play in bringing that impact about? And we've got a framework for how we define enhanced development impact that looks really in large part at the depth of the impact that the transaction will bring about, and also at the scale of the impact that the transaction could bring about. It covers both inclusion in terms of kind of who it's reaching and whether or not they're truly low income, but also it has a climate dimension, which really looks at whether or not a transaction is transformational in terms of climate impact. And then we also, from a scale perspective, consider how much private capital we can mobilize in a given transaction. So those are kind of really the aspects that we look at in terms of whether or not the transaction is really impactful and really warrants that catalytic capital. Then beyond that, we think very carefully, and much of our investment committee discussion looks at what we call the path to commercial sustainability. If we really want to make the most of the catalytic capital, then it needs to be a temporary subsidy as far as possible. And some of the timeframes in these transactions are very long, particularly when we're talking about some of these whale funds, for example. Many of them are investing in infrastructure. Some of them have tenors that are sort of 20, 25 years. So it's hard to kind of think about how you you have to look at the successor funds or the funds that are kind of going to come that sort of emulate what those funds are doing. But we're really kind of concentrated in our investment committee discussions around what types of private capital we're really trying to attract into a particular transaction. What are really the barriers to them investing in this sector or the market that the transaction is looking at? And how will our participation in the deal with the instrument that we're looking at really change the way that they consider that investment? And we really ask ourselves, could we structure it differently? Could we use a different instrument? Kind of what would make the biggest difference? And how can we create that pathway so that the next deal or the next kind of round, if it's at a company level, will have more private capital in it. And then, of course, we really test ourselves on whether or not we're minimizing concessionality in the deal. In an ideal world, we would have benchmarks, and we're certainly building our internal database of benchmarks. I would say we're still relatively new to this compared to some of the MDBs in particular, but we're starting to have some of our own internal benchmarks. Your data set and other data sets, the OECD data sets that are out there are helpful in terms of being able to look at comparable transactions. But to be honest, in most of these markets, the fact that we're using catalytical capital is a sign that actually these are generally underdeveloped markets, and therefore actually the benchmarks are very hard to come by. So we kind of have to use other, sometimes more qualitative methods to really consider the level of concessionality. So we kind of think about, how quickly did the concessional capital come in? Did we really kind of test the market without the subsidy before you introduced the subsidy? How have we validated the need for that concessional capital with third-party reviews or conversations with others? And kind of what are the motivations and intrinsic incentives of all of the parties around the table? So that's kind of the path to commercial sustainability and that minimizing concession are really key for us. Joan, you also asked me kind of what the role of DFIs more broadly is. I think at this particular time, we can see in this report that actually it's interesting that last year ODA volumes played a bigger role, and now of course they're dropping off a cliff. So that kind of does raise some questions for concern, and a lot of that is flowing through the DFIs and MDBs. I think we understand many of the markets, certainly where we're using blended finance and emerging markets, the DFIs and MDBs have got track records. So the more that we can bring that track record and that experience to the market in terms of data, in terms of case studies, in terms of the tools that we use, I think that's really helpful for others who are trying to bring into these markets. I think we're going to need to partner more with each other. Where there's scarcity, we're going to need to be more intentional about co-investing and kind of sharing experiences and sharing deals. We're going to need to think hard about instruments. I think the team just talked about kind of different types of instruments and sort of the different levels of efficiency. I think that those kind of calculations, the degree that one can have calculations around kind of grant equivalency or grant intensity are going to become more important. And they're not always actually intuitive. Sometimes actually a small grant can be more effective than a larger quantum senior loan in a deal. So I think we really need to ask ourselves questions about what instruments we're using. We've talked already about the fact that guarantees and credit enhancement is a very effective tool, and we'll probably see more of that going forward. I think that's a continuing trend. The last thing I'll just say, Joan, is I think obviously the hope is that blended finance can really be a way of crowding in this more private capital into these markets, which is going to be more and more important now that there is less ODA there. But the role of DFIs and MDBs in a large part is to really do some of the pioneering transactions as well. So whilst we can play an important role with some of the concessional capital and with our experience in drawing in private capital to some of the more mature markets, the more mature assets, we also play an important role in terms of doing pilot or pioneering transactions in some of the less well-developed markets, whether those are tougher countries or tougher, more nascent sectors. And it's important that we continue to play that role even in this environment. Otherwise, we won't have the deals that are bankable for the private capital to do. So we need to kind of maintain both the pioneering side and the mobilization side, and blended finance can play an important role in both of those.
Thanks, Sarah. Yeah, your discussion about looking at the internal mechanics of transactions as well as their systemic impact, that really hits home for me, and how do we measure these? And of course, the scarcity of data on which to benchmark, and then the role of DFIs in leading the field. I think all of those are really important points that you've brought up. I'm going to turn next to Gates Foundation, IFTIN. Philanthropy does not show up as frequently as official development aid does as a source of catalytic capital and blended finance. So in a low OD environment, how do foundations play a more prominent role, either as providers of capital or other? I will let you take that question however you'd like to take it. Over to you.
Great. Thank you, Joan, for the question and for the invitation. This is certainly a very salient topic for this moment we're all in, within the development finance space. So at the Gates Foundation, we're primarily a health-focused foundation, and we look at blended finance in a few ways. So I sit within our development policy and finance team, where we fund research and analysis around blended finance. And I have colleagues as well that are in our various programmatic teams like health and agriculture, women's economic empowerment, that occasionally participate in blended finance transactions by providing concessional capital within the overall capital stack. So philanthropic actors such as the Gates Foundation and others, I feel, are uniquely positioned to fill some of these structural gaps in the blended finance ecosystem more broadly, not just with the concessional capital, but with data, evidence generation, as well as convening power that we was alluded to kind of earlier in the opening remarks. Of course, philanthropy won't be able to fill this gap that primarily has been left through the dissolution of USAID. I know many of you have heard of the recent announcements from the Gates Foundation kind of winding down in the next 20 years. Bill has been very specific in the fact that we're not able to fill this gap, but we will do as much as we can with the concessional capital that we have within the years that we have left within the foundation over these next 20 years. I believe that philanthropy, in particular foundations, such as the Gates Foundation, can really play a prominent role as providers of catalytic capital in blended finance, especially in this kind of recessionary ODA environment that we're in, where it's more critical than ever to leverage scarce concessional capital for maximum effect. I can highlight a few examples. I think, of course, first, the obvious example is de-risking early stage investment, whether it be through grants or first loss capital, to absorb some of those higher risks, particularly in impact sectors that don't get a large share of blended finance volume, like health, education, agriculture. The conversation kind of tends to be dominated by climate and infrastructure deals and these whale transactions, but really some of those very impact first sectors often see lower volumes of blended finance. So we're really looking at how can we de-risk early stage investment within the space. We really see also philanthropy's role within convening stakeholders and building an ecosystem and using voice in that respect. We have an advocacy and communications function to that effect, where we try to use our voice in strategic ways. It was mentioned earlier, this kind of publish what you fund work on data and transparency. We were one of the core funders of that and really believe in that work, and the need to push MDBs and DFIs to publish more around mobilization figures. And we're also happy to see the GEMS data, become more relevant in the discussion and kind of demystify some of the risks around primarily investment in EMDEs, or emerging markets and developing economies. And then I would say as well, advocating for systemic change, which would include working at the domestic capital markets level, promoting regulatory and policy reforms that are really necessary to unlocking domestic capital and creating enabling environments to promote private investment, whether it be domestic or international, in some of these challenging regions. And then lastly, I would say, and it was also alluded to earlier, but really one of the key ways that I think philanthropy can be really catalytic is in providing technical assistance in the design and structure of blended finance deals. I think oftentimes, in my view, having a more of a co-creation approach, you have more of a likelihood of success in that, rather than kind of designing the fund and then shopping it around for fundraising, you have a little bit more of a chance for strategic alignment if those conversations are approached in a more collaborative, co-creation manner. So those are some of the areas where I see catalytic philanthropy and capital can be a little bit more catalytic.
Yeah, you've brought up some important points. First of all, philanthropy cannot just step in and replace official development aid at that scale. And it's not just about money. It's about how you engage and how you advocate and at what point in a transaction's lifespan you engage. And all of those are really excellent points in this moment, particularly. Marie-Aimée, I want to turn to you in Société Générale. So where is concessional capital most useful in bringing forward a large-scale investor like yours into a blended finance transaction? And taking the same theme forward, if ODA is scarce, how do providers of catalytic capital maximize the effectiveness of their resources if they're trying to engage institutional investors? Can you address that for us, please?
Sure, thank you. So first, you mentioned Société Générale as a large-scale investor, which we are. But I think it's important to underline that increasingly with the Basel III and Basel IV prudential regulation, it's very difficult for commercial banks to deploy capital to medium-term financing in emerging markets and developing economies because of outdated and overly punitive rules that even in blended finance structures give us an unprofitable investment proposal. So today it's still a big hurdle for banks, and that's why we're trying to address it collectively. And for this, I'm pointing to a very interesting white paper from the International Institute of Finance that addresses this in particular, which will try to take forward and make recommendations and implementation to free us up a bit to be more active. But that's why I think banks like Société Générale and others today we're more originators of well-structured transactions or portfolios that we aim to bring to the larger asset or smaller asset managers and asset owners. So you're asking me where is concessional capital most additional? So to start, and I'm sorry to say that again and again, years after years, and I see Sarah is smiling, but for a start, we need, it's more additional when it's crowding in and not crowding out commercial banks. And unfortunately, we still have, again, this month and the prior months, examples of situations where private banks want to come in transactions and they are not invited, or there is restriction on the number of commercial banks that can come into a transaction arranged by an MDB, or to a lesser extent, a DFI. So this is really the first step to take, I think, because most of the ODA concessional capital goes as capital, equity capital to MDBs and DFIs, as well as they give them concessional capital, which private sector doesn't have access to. So it's essential, I think, as a beginning, that there are ambitious targets given to DFIs and MDBs, or that DFIs and MDBs are giving themselves, like BII is doing, like IDB Invest is doing. So I'm not saying all of them are in the same bucket, but that's the first step, and that these are monitored as key performance KPI for those actors. And then another step that can be taken is also to be more transparent as to where, and that's both for public and philanthropic capital, more transparent as what is the concessional capital that they have available, what is it targeting specifically, how it can be accessed, and who's in charge. Because today, each private sector actor that is looking to structure transactions and that is in need for de-risking capital, I see you are shrugging. But yes, we have, it's like a really very considerable amount of time and effort that needs to be deployed. And so that's why we've come with to this idea with a group of private sector representative and the Institut de la Finance Durable, IFD, and BCG, this idea of creating a catalytic capital repository, which is very simple, database where owners of catalytic capital can make available on the same place, in the same format, what are their envelopes, how they're going to be awarded, and also trying to encourage those catalytic capital providers to actually award it with the multiple, the private sector mobilization multiplier as a key criteria. And I think in this extent, be a very good example of best practice. Since recently, they've awarded 50 million of kinetic capital with a minimum 5-to-1 private sector mobilization as a key criteria to actually allocate this capital. So in a nutshell, in a reduced ODA environment, blended finance is absolutely key to do more with less, and to be more efficient. We need more transparency, and we need specific targets for the owners of catalytic capital.
Thank you, Maria-Mi. And so 2 important points. One, regulations are sometimes prohibiting you from doing things that might be really smart ways to engage in development transactions. We've heard that from a lot of parties. We've also heard the difficulty of understanding the array of concessional resources and the rules institution by institution for how to access them. So 2 really important points. Last but by no means least, I want to turn to our representative of the Ministry of Finance of Rwanda, Nick. Yours is an important voice because, of course, this is the kind of country where blended finance is supposed to happen in. So talk to us about how governments in emerging markets and developing economies can best support private sector mobilization at home and support blended finance in an environment where less aid is available from people in the global north. What can you do to direct your own fate and demonstrate leadership from within a developing country?
Well, thank you, Joan, and very good afternoon from Kigali. I'm here in the Ministry of Finance, where I serve the team as an in-house advisor on indeed these precise topics and related topics around international funding. So indeed, the world is ushering in a new era where emerging market governments must themselves become catalysts in blended finance, not just counterparties. In other words, we can no longer be passive recipients. We have to lead as mobilizers, as standard setters, as co-investors. Governments must lead by example, so allocating scarce public capital strategically, not just more money, but smarter money to de-risk transactions, not just to subsidize returns, shifting from grant-based support to risk-sharing tools, first loss tranches, partial guarantees to de-risk private investment, but without distorting the markets. I think secondly, governments must be enablers, and we've heard this once or twice from around the panel, of investable SDG-aligned sectors that requires national climate or nature taxonomies. We launched our green taxonomy at COP28, clear regulatory frameworks for blended instruments. We launched one last year here in Rwanda, and of course, support for standardized project preparation and structure. I think thirdly, as ODA reduces around the world, of course, one turns first to the international private sector, where the scale is largest. But we ought not to overlook also the domestic mobilization, growing and or both, unlocking our own pension funds, insurance firms, and banks. I think finally, we need more sovereign-led facilities and platforms that can crowd in both domestic and international capital with transparent pipelines and governance. And indeed, of course, our own experience here is a case in point. But let's be very clear, grants are incredibly welcome. But the future of blended finance cannot depend on the solutions of the past. Governments must now lead in the emerging economies by building our own platforms, standardizing our own transactions, and inviting the world in, not as parachutists, but as co-investors in our own priorities. Joan, back to you.
Thank you very much. And Rwanda is indeed a leader that we see out there in government-led blended finance. So your remarks about being an enabler and creating national platforms and about making sure that domestic actors are drawn into the equation. Those are all really important, I think, for other countries to take note of. We're starting to get questions in from the audience. And so in lieu of asking you my own questions, of which I have many, I might bring out some of those questions since they're actually potentially pretty interesting. Somewhat controversial one for you, Sarah, or provocative one, I should say. On the question of impact, we have a question, what difference does it make if one business has a more solid impact profile than the other, if both are contributing to climate objectives? Can this lead to preferential cost funding as an incentive to mobilize action? So I think what they're getting at is that tension of objectives between seeking impact on other fronts and impact on climate. So if you have, for example, two opportunities and they both have a solid climate objective and one has other impact, like how do you weigh all that? And I might be distorting the question, but I think it's an important one when you are managing ODA money.
Yeah, it is a very important one. I guess a couple of thoughts, Joan. One is just to note that we have a kind of an impact framework that we use for all of our transactions that looks at the inclusivity, the sustainability, and the productivity of every deal. So the climate lens is kind of within that sustainability bucket, but we're looking at all three on every deal that we do. And I suppose, given that I've just sort of outlined that, you can imagine that every deal gets a score of out of 10. And so if you are if it's a deal that is having climate impact, but that is also inclusive and contributing to productivity of an economy or a sector, then actually that would score higher across the framework. So we're not only looking at climate in isolation, and the highest scoring deals are contributing on all fronts, I guess. With respect specifically to the catalytic capital, and this is something that I think is interesting for us to kind of talk about as a group. A lot of the time, the donor money has specific impact objectives. So it is the case for us at the moment that the vast majority of the catalytic capital, or specifically the blended finance capital, Maria-Mi used the name that we have for it, our kinetic portfolio, has a particular focus on climate. Both we have some that are specifically looking for climate innovation, or kind of that transformational deep impact that really can take early stage risk on top of the instrument risk that blended finance can take. But some, as Maria-Mi also mentioned, that is focused on how we can mobilize private capital at the scale of kind of 5-to-1 leverage ratios for not only for climate, but with a particular focus on climate. And so I guess within our blended finance portfolio, we do have a particular focus on climate, and that comes from kind of our shareholders' priorities to some degree as well. But certainly across our entire portfolio as BII, and if we include the catalytic capital that we have on our balance sheets, we are very evenly spread across sort of climate and also that inclusion lens.
Thank you. Yeah, so it's a holistic approach in which you measure various things, but you also have to take your donors' requirements into account. Thank you for that. We also had a question, Maria-Mi, for you about, can you maybe give us an example of where regulations tend to bind you in an unhelpful way? I mean, we know why regulations exist, right? They're there to protect the solidity of the financial system. So let's start with that. They're not evil, but can you give an example of a regulation that has tripped you up when perhaps it shouldn't have?
Sure. So with the new Basel III and now Basel IV, because Basel IV is, I think, in 2 or 3 years, but we start applying it as we are originating medium-term transactions that will still be on the balance sheet, at the time where Basel IV is going to kick in. So with these 2 new sets of prudential rules, banks cannot use anymore their internally developed capital allocation model that is based and back-tested on our own track record of doing infrastructure or energy or other, project finance transactions, where we could have demonstrated low default rate and high recovery rates. So now with these new rules, we have to go by a standard measurements, standard percentage for the default rate and for the recovery rate, which are more onerous. So that's one example where for a same given transactions, with the new regulation being implemented, we suddenly have much more capital to put aside, and therefore we have to require a higher pricing, or we have less appetite overall because we cannot, find the pricing that makes it work. Another example, and that's very specifically a problem for blended finance, is that if we receive a first demand guarantee that is first loss or that is pari passu, there is no way to differentiate the impact when looking at the benefit of these two different kinds of guarantees to a loan that we have made, which obviously is completely insane because the first loss, first demand guarantee is much more, it's a much higher credit enhancement than the pari passu one. So that's another example. And I'd say the third example is also the way a country in emerging markets are rated. And so just the rating of the country creates a very high risk weighting, regardless of the fact that we've been doing business in this country 50 years, 100 years, and had no significant loss or maybe a lower net cost of risk than in the US or elsewhere. So there's this issue of too much standardization that disregards the actual track record from any given financial institution.
Yeah, so I hope that comes out clearly for the audience. There's outright banning by regulation. There's unhelpful effects on pricing, and then there are unhelpful effects of countries being rated by rating agencies in a blanket way that doesn't reflect sometimes what the risk might be to your transaction. I want to turn back to Nick. Rwanda has done some very interesting things in blended finance. I'm thinking, for example, of the sustainability-linked bond you did that was backed by the concessional window of the World Bank Group, which is IDA. It was a very successful issuance, and the coupon rate was structured so that it stepped down as various targets were met on, I think, gender and other housing and climate, if I'm not remembering wrong. So you've really led as both a bank and as a government in blended finance. Do you have any lessons for other developing country representatives who might be listening? I mean, your voice is incredibly important here. If we are talking about local governments and local mobilization, tell us what you've learned as a government and what other emerging nations might take away and apply.
Thank you for that opportunity, Joan. As you say, the Development Bank of Rwanda transaction is a case in point of what I was describing earlier on the call. And let's recap what it did. It as you say, took a $10 million IDA allocation as default collateral into an escrow account in order to raise a multiple of that to the account of the development bank, as close to $30 million. Sold to 120 investors domestically across local pension funds, asset managers, insurers, microfinance, and retail investors, banks as well, of course, listed on our nascent stock exchange. So it did 3 or 4, I think, significant things by virtue of its coming together. It mobilized domestic capital. It developed our local capital market alongside. It lowered the funding cost for the development bank and therefore, of course, lowered the borrowing cost of domestic clients of the bank. And it put in place hard incentives, as you mentioned, with the coupon step-down mechanism to drive the SDGs. So lessons, I think, number one, primarily from the BRD team, is that technical assistance and concessional funding can be catalytic, not distorting, ought to be catalytic, not distorting. The 10 million from the World Bank was not a subsidy, it was collateral that enabled a better credit rating, which then in turn attracted commercial flows. I think secondly, as a lesson, local mobilization is about trust. Investors want clarity on how their money will be used and what the impact will be thereof. And the KPI linked structure delivered that, gave them that visibility. And the point is this, that we need to treat local investors with the same high standards and expectations that we would foreign investors as we look to unlock that capital through these sorts of structures. Now, challenges are, of course, the depth of local markets, such as ours. Many domestic institutions are smaller in scale, they have lower technical capacities, and they do remain somewhat conservative on risk, of course, overweight in sovereign debt, short-term instruments. And the pipeline readiness, we addressed this earlier on, we still need to convert SDG-aligned projects into investment-ready assets. And we've got a new unit here at the Ministry on Climate Finance to address that, for example. So the BRD bond, it was a beginning, not a blueprint. The next phase is about scale, building platforms, replicating success, and proving that blended finance is something that we can lead from within. Thank you, Joan.
Thank you. Yeah, and some of what you're talking about is having the right structures to get things done. And that is obviously one thing to take away. And the other point that really hit home for me is that the structure the bond you chose to put out had no crowding out effect, right? The item money served to attract, but it did not replace or compete with the private capital you're trying to attract. So it's really an interesting structure. I want to turn to, and we will take some more audience questions in a second, but I want to come back to Iftin on the subject of collaboration. I mean, when you think about it, we've seen various collaborative exercises among donors. So in the ODA world, there was the Hamburg Sustainability Platform that we mentioned in our report, also the Investment Mobilization Collaboration Alliance, also known as IMCA. And then if you look in the philanthropic world, we at Convergence have been following and working with the Catalytic Capital Consortium, which is another example of collective action. So in the foundation world, if you're trying to get more blended finance done and done well, how do you better collaborate with other providers of catalytic money to support, private sector capital mobilization? Do you have some comments around that?
Yes, yeah. Actually, it's probably one of the more important aspects of this topic because I think honestly, collaboration is probably more critical than ever. Given that concessional capital is more scarce and subject to increased demand, right? So we're in this environment with doing more with less and stretching our dollars. So I might talk to the Hamburg Sustainability Platform that you noted earlier, as I'm most familiar with that. But I really think that that's a very relevant example in that it aims to serve as this sort of standardized single window broker dealer to kind of connect supply and demand for concessional capital, targeting institutional investor mobilization, and really creating standardization at the structural level, not just at the transaction level where many of us are kind of focused. And Convergence's work actually on the scale private investment, private mobilization project is really kind of complementary to this. And Gates Foundation serves as one of the core funders for that project. So I really think that foundation should work to better collaborate with other catalytic capital providers like donors and DFIs, multilaterals, in a few key ways. We're doing this already, but I think these efforts really need to be kind of ramped up more, particularly in the environment that we're in. We've talked to this kind of throughout this call, but really collaborating more on standardizing, particularly instruments and processes. I think one way that the Hamburg Sustainability Platform does this is that it's working to really having multiple actors kind of streamline different aspects within the process, like impact metrics, for example, with the goal that this would kind of thereby lead to reduced transaction costs and increasing the replicability of these sorts of transactions. Because the way in which it's really done now, it's obviously too bespoke. And all of this kind of given the understanding that increased standardization leads to more deal volume. So I think we, as a group, collectively, we need to kind of move away from this kind of deal by deal model and move towards more of a platform-based approach. And then this is really facilitated in more of a collaborative effort between philanthropy and donors, while we also kind of leverage our, complementary strengths, right? So with philanthropy, the funding tends to be a bit more flexible and risk tolerant, and really complementing that with donor and DFI tools like guarantees, for example, so that you're structuring more effective and kind of sustainable deals. I will also note what we're really focused on across the foundation is kind of driving innovation through joint partnerships. I think Alyssa noted this earlier in her opening remarks, kind of on the investor landscape portion of the presentation, but she highlighted the Human Development Accelerator, or HDX, and this is really an example at the foundation of a joint partnership. So HDX is effectively, this initiative under Global Gateway, which is the EU's kind of contribution to narrowing global investment, the global investment gap worldwide. So HDX really brings together resources and expertise from the European Commission, and it's matched with it will kind of deploy over time 790 million euros in guarantees. And it's provided by the EU, or the European Commission. It's matched with kind of 250 million in co-financing from the Gates Foundation. And it would really allow the EIB to make otherwise, unbankable debt, equity, and guarantee investments in global health areas like stage 3 trials, where the foundation lacks sufficient kind of co-financing opportunities, and DFIs are normally kind of unable to invest. So we really view HDX and other similar collaborative partnerships as really kind of key to leveraging larger pools of capital and accelerating innovation. So we're really looking for ways in which we can scale up partnerships like HDX with the EIB, perhaps with other MDBs in similar such ways. So we really view collaboration as key.
Thanks. What it gets at is collaboration as a device to think about standardization, not at the deal by deal level, as you're saying, but standardization process, standardization of approach, so that you can roll off more things from an assembly line, if you will, which gets to a very interesting audience question, which will be a free for all. Okay. The question is, do the panelists agree with this statement? Blended finance deals take longer to structure and close because of the multiplicity of stakeholders involved. And paradoxically, society would do better with higher velocity of deal making to meet the SDGs. So how can we improve the velocity of transaction making? So complexity versus velocity. And anybody feel free to, Iftin, why don't you take it off, and I will open it up.
I'll take a stab at it. I mean, I worked in development. I was at a DFI kind of throughout most of my career. I can say yes, blended finance transactions take too long to do. They're overly complex, overly structured, and we really need to get the time it takes to get a transaction from concept to disbursement to 6 months, if possible. They take, frankly, quite frankly, take too long, even among just DFIs themselves. So there's a lot we can do in terms of harmonization of both due diligence, impact metrics, legal documentation, structuring of terms. It just simply takes too long. And having a more platform-based approach can potentially ensure a way that you get more volume, as opposed to going deal by deal and spending upwards of 12 to 18 months in some cases on a single transaction. And we simply cannot move at that speed anymore.
And then the repository that Maria Mie mentioned of what donors have on offer, that is another platform that potentially could speed things up. I love the call to action of 6 months to close, because frankly, firms like Société Générale, if they have a live opportunity, it's not a live opportunity 2 years later. So it's not helpful to wait. So, but I'll turn it over to you.
I'm afraid.
What do you think of the question?
I'm afraid that people who have been active in project finance in emerging markets know that these deals, they take, often no less than a year or 2 or even 5 from the RFP or the preparation of the RFP to the moment they close. So we are used to a long lead time. I think the investors that we are reaching out to bring in, so insurance companies, private equity funds, asset owners, family office, who are increasingly looking at these investment strategies, they need a faster investment cycle. They are looking at relative value of what we're proposing towards other opportunities, and they cannot wait so long before making their decision. So completely agree that we need to shorten it. And one thought I want to share, which I often come to, is when there was COVID, it was super rapid, because in front of the emergency, everybody could suddenly changed their process. People who were producing perfume, they suddenly were able in 2 weeks to produce masks. Everybody was, turning around, finding a way to do it, and everything was faster. So we have to really do a better job at conveying the fact that this is as urgent, even more, a situation as COVID, because we're talking about billions of people who are going to be displaced or dying if we don't take action now. And so people are able to do things faster and simpler everywhere in the companies, in the DFIs, in the governments. It's just a question of leadership and passing the urgency of the situation to actually force simplification and faster processes.
Thank you. Nick, why don't you chime in for us, please?
Thank you, Joan. Well, I would concur with the assertion from the audience. We spoke earlier around the ambition to scale that which works on a sort of smaller footing. But of course, scale with speed is indeed an important coda to that. Sophistication is often sort of how we might describe this market versus the sort of vanilla funding market, which of course we know so well and so standardized and commoditized in many respects. But it was, I think it was Leonardo da Vinci that said simplicity is the ultimate sophistication, and we have to focus on that simplicity if we want scale with speed.
Joan, maybe I'll just add one thing. I've responded to Quentin, who asked the question, with a link to the paper that BCG and BII wrote and published last month around some practical tools for how we can try and speed up transactions. The two tools are a set of archetypes for blended finance funds, but also a scorecard for kind of how to assess them. And we are finding those useful ourselves, and we hope that others might try them out, and we can jointly refine the tools, and hopefully they will enable us all to kind of identify certain types of transactions quicker and have accelerate conversations and deals. But I think the thing that is important in all of this as well is that some of the complexity comes from the donors, whether those are governments or government agencies or philanthropies. We all, if we call ourselves a community, we like to be creative and to be innovative. A lot of this community refers to themselves as the innovative finance community. And innovation is great when you're dealing with complex challenges, and it's important when you're thinking about minimizing concessionality. But there needs to be a bit of a mindset shift towards actually copying and pasting is a huge win. And if we can celebrate replication instead of kind of starting from scratch, I think that would be a huge move forward.
Yeah, I'm on record as being somewhat anti-innovation, and I don't mean that about certain areas where business models are still being developed. I mean that around terms and conditions of known objects like fund structures and bond issuances. I don't know that innovation is helpful there when you have an asset class that investors actually recognize already. I'm going to turn to one other question we got, which is, can we step away from talking about the large deals for a moment and talk about how do we address the missing middle finance, funds that are under 50 or 100 million, direct investments that are small. How do those kinds of transactions fit in the broader blended finance world? How much attention should they get? Do you each give them? As opposed to the whales that we mentioned that really moved the total value of blended finance in the past couple of years. I don't know who would like to take that question, and you're welcome to. And it strikes me that among all of you, Iftin, I don't know, since philanthropies have such flexible capital, maybe this is one area where you can really shine, is in these smaller transactions. Would you like to start us off?
Right. Yes. So yes, typically our interventions, range from kind of smaller grant dollars to kind of larger grant support. Kind of similarly to development finance institutions, we also work a lot with funds as intermediated vehicles to kind of on lend or support on lending downstream to MSMEs. We do a great deal of that through our women's economic empowerment work, where they're actually also focused on nano as well as micro SMEs. As you know, procedurally, it's almost just as amount of diligence and effort to kind of work on an MSME deal as well as a kind of a larger deal transaction. So to whatever extent we can, we really try to leverage impact through working with financial intermediated vehicles, fund structures within this kind of private credit space so that we can kind of maximize or amplify our impact. We do make a number of small grant dollar contributions to within the health space as well as other spaces, but from a impact standpoint, we also leverage funds and intermediate vehicles as well.
I'm reminded that we're getting toward the end of time. So in the interest of time, I might just add very briefly that I'm not sure that the two objectives of the missing middle and the small medium enterprises on the one hand and larger scale blended finance are always in opposition to each other. Sometimes it's efficient to blend once at an aggregate level. So, for example, the credit lines to banks, to local banks, or guarantees to local banks, who in turn, invisible to us, can go do a series of smaller transactions. That would be an example of a larger format blended finance transaction that actually touches on those incredibly important SMEs and even nano entrepreneurs. So I just wanted to park that there. Let me thank you all and close out with a few just thoughts from Convergence's side. So first of all, Sokjen, Maria Mi, thank you very much. And Sarah from BII, thank you very much as well. Nick, really appreciate hearing from a national government. So it's our pleasure to have you on board. And Iftin, thank you for your views as well. I think the audience gained a lot by hearing from people who are on the front lines and not just Convergence. That said, my reflections on today and on our report are, I think blended finance showed some sturdiness and some not great conditions in 2024. I'm heartened by the fact that the private sector component of the market remained pretty even though the overall market dropped. In other words, fewer of other people's money going to about the same amount of private money. I think we face some more difficult weather ahead. So we all have to absolutely get more efficient. With structures and approaches and platforms and systems change, everything all of you just talked about. There are many voices and many constituents working on all of those things. And so I encourage all of you to keep going and to collaborate with each other. We at Convergence will continue to guide, educate, and connect all of you participants in the field and to accelerate deal flow in the blended finance space. Our publication is offered to the market in that spirit. And we encourage you to engage with us through other conversations and to review the conclusions and the recommendations in our report. Let us know what you think, share your own experiences, and thank you all for all of the work you all do. We are delighted to support you, and we hope that we're all out there having some good impact on the SDGs and on the climate front. So without further ado, let me close us out a minute or two early even, which is unheard of in these webinars. Really appreciate everybody's attention, and we hope that it was an interesting session for all of you. So good evening or good morning to all of you, and thank you. Bye-bye.